One concept I would like to mention here real briefly is the reason why financial investors like that oil momentum strategy. Because oil momentum tend to work really, really well when everything falling apart. So here on the graph, I have an oil momentum return versus just a long position. You can see that you're making a lot of money when everything is falling. When the oil price is falling, the momentum making a lot of money. And you actually can do the same graph versus equities or bonds. So that basically means when everything in the market goes south, for whatever reason, something happened in the market, oil breaks down very fast. And I'll explain later why. We call it like up the stairs, down the elevator. So investors really like that, and they call it crisis alpha or momentum smile. So they like investing in oil momentum as a hedge against everything else is going down. Well, just imagine if something happens like in China, in the global economy, and if equity markets are about to correct. So this is the times when the oil momentum, especially on the downside, works quite well. And again, I apologize, the formula somehow disappeared here. That wasn't my intent because but again, you can see in a couple of papers in the public domain. I mean, there's no intent here to hide. So the carry is even better strategy. So what carry does, remember how investors learn that you should be buying oil when the market is backward and selling it in a contango. And this is probably the most important slide in that presentation. So the reason it works, it has a very strong fundamental rationale. So the largest trader in the oil market is not actually consumer or producer or a CTA. The largest trader in the oil market is an inventory hedger. All these companies like Vital, Glencore, Trafigura, my former employee, they are holding massive amount of inventories either in storage or on the water. Oil is being transferred in ships. There are enormous amount of oil at any point in time on the water as well. And it's all religiously and diligently hedged. Generally, the thesis works as follows. If the market is contango, let's say you're on the orange line. Fabio, do you see my cursor on the screen, by the way?
No.
No? Okay. So if the market is contango, the storage trader buys it in the spot market where it's cheaper, puts oil into storage, and then sells futures in the futures market as long as futures exceed the spot by more than the cost of storage. So they're collecting this arbitrage by selling more expensive futures and buying the physical. We don't know what's going on in the physical market. We have no way of seeing it. But what we do know that as long as the market is contango, they're going to be selling futures to hedge their physical. So that persistent and selling futures create a steady downward pressure on the prices of oil in the futures market as long as we are contango. And then if the market goes backward, they're going to pull oil out of storage, sell it in the physical market. Again, we don't see that. And they're going to buy back the futures. So when the market flips backward, they will be buying futures back, pushing the oil prices up, which basically means it's the same signal that killed financial investors in 2005 through 2008. Because it justifies why you should be selling oil in the contango market and buying oil in the backward market. So that's called the carry strategy. This is a beautiful strategy because it has no parameters. It's a model free. You don't need to optimize. You don't need any look backs. All you're doing here, you're looking at today's shape of the curve and you're buying and selling if it's contango backward. So that simple dumb strategy generated you nearly 20% return unleveraged. That's all unleveraged. And you can easily leverage futures by a factor of 5 with Sharpe ratio of almost 0.5. But the only downside with carry, it's very kind of slow because the market doesn't flip between contango and carry very frequently. So you may be in backward for a couple of years. That's too slow. So what CTAs are good at, they learn how to blend signals of different nature. And here is an example of so-called signal blending technique. This one I called carry momentum. Remember momentum, you buy and sell oil when the price moves above or below its moving average. So what you do here instead, you apply momentum signal not to price, but you apply momentum signals to the carry. And carry is a term structure. For example, if the term structure is backward and the backwardation accelerates, you buy. If market is backward, but backwardation decelerates, you're still backward, but it's flatter. The momentum on backwardation is flattening it, then you sell. And similar, if the market is contango, but contango steepening, you sell. But if the market is contango flattening, you buy. So basically what you do, mathematically, you apply momentum to the carry. So let's say you define carry as the difference between month 1 and month 12 futures, annual roll. So, and you apply momentum to this spread. You don't apply momentum to price, you apply momentum to the spread. And that strategy generated nearly 25% annual return over 30 years, unleveraged, with very high Sharpe ratio. Just one commodity. But this is an example of a signal blending where you take two concepts, carry and momentum. You don't add them up, like average them. No, you do it in a kind of tricky way. You apply the concept of momentum to another concept of the term structure. And the reason it works, as I told you in the previous slide, so backwardation contango kind of tells you something about today's state of the market. So if market is backward, that means inventories are probably low, supply is below demand, but we already know this. So that's in public knowledge. The market does not trade based on today's state of the world. The market always trades based on forward expectations of where we're going. And the idea here is that momentum applied to the term structure, that's what CTAs are using as a proxy for forward expectations. So they're trying to decide, yes, we know we're backward, but are we going to be more backward or less backward? So when you see, for example, in the market, the term structure is rapidly decreasing. We still may be backward, but it's decreasing. That's a massive, massive bearish signal for CTAs. And you probably have seen it, and I sometimes go on Twitter when I see signals are changing. So this is probably one of the most important signals that you can see in the CTAs market.